Date the rate, marry the price. I think it's really important to understand when the market's 20% down, like multifamily is more than 20% down right now. And when the market is 20% down, then what you want to do is you want to be able to buy that piece, because that discount, that 20% discount is now permanent. It is something you're truly buying it at. Instead of buying it at $1 million, you're buying it at $800,000. Well, that's a $200,000 savings in that price. And then you finance it. Well, wait a minute, my payment might be higher. Gosh, if my interest rate was 4% on $1 million versus 8% on 800,000, my rate's higher. Isn't that a horrible decision? And the answer was, well, no, not really. Here's why. Because in 3 years, you refinance it. You're dating the rate. You're going to refinance it out at 5.5% or 4.5% when the rates go back down again. And now you have an $800,000 house that you purchased that now has a 4.5% to 5% interest rate on it. Now you have your ideal investment.
After that April 2022, when the Fed continued to increase rates, it's really hard to make something pencil out. You almost got socked in the face, boom, and your cash flow just didn't happen. People approach us as real estate agents.
The whole market got socked in the face in the multifamily market. I mean, the whole market did. I mean, it's gone down by 20%.
When we talk about people, if you're in it for cash flow, it's going to be really hard because you have to date the rate and marry the price. So we're going to get a discount on these apartments, right? You're seeing 20-30% decrease, you were saying, Christina, in prices, which means that's your basis. So whatever you buy that property, whatever you depreciate it and use it for financial reasons, that's going to be your basis. You're going to be able to use that. Your rate, you're going to be able to refinance it later, right? And you're kind of hedging on that because I'm not predicting anything, and unfortunately rates are not going to go down anytime soon.
If you're buying in September, you're basing it on comparable sales from June, July, and August, right? So and your June sales really happened in May or April, and they closed in June. And so when you're looking at those numbers, I can't replicate that when I buy it in September and my property is going to hit the market right at Christmas or somewhere during the holidays or maybe just shortly after the holidays, right? Now I'm kind of at the bottom of the market there, at the low volume point and also the low value point. And so I tend to, like, if I'm going to buy something around September or October, I'm looking for the better deals. I get very aggressive on straight fixers the month of December, late November, December. I know that's the bottom. I'm trying to buy as much as I can. January, usually what happens is there's a lot of people on vacation, so I have less competition. But it's also, I know that it's the lull of the market. Even if the Fed doesn't, let's say, lower the rates from a Fed standpoint, I think rates can still come down. And we kind of saw that happening a little bit. And because right now, the banks have a very high margin. Their margins aren't as low. And the reason they have high margins is because, just think about it from a business standpoint. If you're a business and you have all of these hard fixed costs, you've got buildings, you've got leases, you've got ownership, you've got labor to staff all of that, but you've got low volume. Your profit margin has to be better. Think of it like a burger shop. If you have one client coming in and you need, that's what's happening. Your burger better be like $150 to sustain your expenses. And so that's what happens in mortgages. Their margin has to be better so that they can profit more to sustain their overhead. And so when volume increases, you'll see competition really increase because people will want the volume. And when they pick up the volume, right, they're going to make more money in volume. And they'll compress their profit margins, and interest rates will naturally come down from a business standpoint and not necessarily from a Fed standpoint.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. All right, hey you, welcome to Real Estate Breakthrough. I've got Nick and Robert with me specifically to talk about economics because it's one of my favorite topics. We just did Phoebe Pasadena and we had a chat about it, and we decided we're going to record this. So Nick is actually officially going to moderate because he is the moderator guru. And we're just going to chat a little bit about what we feel like is going on for you as investors and what is it that you need to know to be able to make powerful decisions in investing in real estate today. So, Nick, take it away.
Great. So the first question I have to pose to both Christina and Robert are, we were talking about date the rate, marry the price. What comes to mind when I say that? Date the rate, marry the price.
Robert, I'm going to go first. I'm going to steal this one for a minute. So, because I don't know where I heard that originally, Nick, but I definitely have heard it for a while. And I really think it's important that people understand the concept of it. And then maybe Robert, you fill in, Robert and I might shoot holes in each other's theories, just letting people know, but we'll see what happens. So date the rate, marry the price. I think it's really important to understand when the market's 20% down, like multifamily is more than 20% down right now. And when the market is 20% down, then what you want to do is you want to be able to buy that piece, because that discount, that 20% discount, is now permanent. It is something you're truly buying it at. Instead of buying it at $1 million, you're buying it at $800,000. Well, that's a $200,000 savings in that price, and then you finance it. Well, wait a minute, my payment might be higher. Gosh, if my interest rate was 4% on $1 million versus 8% on 800,000, my rate's higher. Isn't that a horrible decision? And the answer was, well, no, not really. Here's why. Because in 3 years, you refinance it. You're dating the rate. You're going to refinance it out at 5.5% or 4.5% when the rates go back down again. And now you have an $800,000 house that you purchased that now has a 4.5% to 5% interest rate on it. Now you have your ideal investment. Your box is clean and clear, but you have to be able to survive the space between. All right, Robert.
So I'll add to that, right? So a lot of people, especially, there's a lot of talk of this coming recession and what's happening with the marketplace. And hey, there's all these millions of government jobs that are going to be lost, and yet there's an offset on a bunch of jobs that are being created in different sectors. And will those employees then go to this other private sector, or will they just become and kind of feed off of unemployment for as long as they can, and so forth? And so there's a lot of fears surrounding that right now. But I will say this, that my best purchases happened during like not necessarily a deflationary period, but a recessionary period, right, for your buy and holds. And one of the reasons is that if you can weather that storm, then you're kind of buying at the bottom of the market, right? And so in this case, I don't necessarily say like today is the bottom of the market, right? I don't necessarily agree with that. But I do think that, from an interest rate standpoint, if you're buying here at slightly elevated rates and rates drop, that potentially the values can increase, or it becomes a better investment, even if the values don't increase, just from a value if the rents, let's say, stay the same, and you can refinance. Now, I will say the risk of doing that is that if let's say we enter a recessionary period, it's not just incomes that take a hit. Rental values also can take a hit. Now, if we're looking back at rental portfolios, right? Rental portfolios have already peaked, right? And so they're already from that trend standpoint, they're not at the top anymore. They've already peaked. They peaked in, 2022, going into 2023, dropped a little bit in 2024 and into 2025. Outside of like areas, outside of, let's say, the Eaton or Palisades fire here in California, which had dramatic increases, right? Like super, super increases. But those are also temporary. And I think that if you look at it, we were just with an economist that if you joined the club the last time, that the overall grand picture, right, the rental increase for that area, even though it spiked, that the average was only, 1.4%? Is that what he said? Right. And so that kind of surprised me. But if you're looking at a standpoint of when to buy, consider this. There's only been 6 years out of the last 48 years that have a depreciating value on a year-over-year basis. And those 6 years were every single one of those years was caused by a banking crisis. So we don't have a looming banking crisis right now. Right, this is an employment issue. There's been other recessions. Look at what happened during COVID. Right, during COVID, we had a very sharp, like a recession that happened very, very quickly. We can call it a planned recession because of of the quarantine. A recession nonetheless. And during that time, things spiked afterwards. Right, and so you had this pent up demand. You had other things. So if you're tracking things, if you're concerned about real estate values, I really implore you to kind of go and investigate what's happening with new mortgage applications, which is a great kind of indicator as to what the demand will be coming forward, right? And we've had 3 positive weeks of new mortgage applications, and so that tells us we're going to have a pretty robust spring, albeit with lower volume, right? And that's what's hurting everyone right now, is that we're in a low volume environment, right? And so they start to think like, well, why isn't things going better? Why, when you have, the demographics that we have, those are all feeding into what's happening, right? And I can base this kind of low demand really started back in you're gonna think I'm crazy for thinking this, but it started really back in the 80s. And it started when homes started being built a lot larger. And what happens when you build larger homes, people don't have to move as often. So it went from, the housing tenure basically happened from, people moved on average 7.5 years. And then it went to 9 years. And then it went to 10 years. We're at almost 14 years now. And so what that's telling you is that, generational homes become more important. Enter the ADUs. Why do you have to move? You have like the opportunity to build another house on your lot. And so all of these things together combined really increase housing tenure. And so if you take a look at all these homes that would otherwise be hitting the market and are not hitting the market because people don't need to move, right? If they don't need to move, and I'm in that scenario too, my kids are, one's off to college, the next one will soon be off to college. We have a larger house, but it's a pain in the butt to move. So why move? And so if you don't have that need, then people tend to stay put. They like their neighbors, they like the neighborhood, it's familiar, there's a cost associated with moving. And so I think all of these things kind of come into play. So if you're looking at investing, just keep in mind, 6 out of 48 years. And if you bought during those 6 years, by the way, you did really well.
Exactly, you did well.
I mean that's the thing, right? You don't want to be, yeah. So that's kind of my take on it, is that there's always a good time to buy. It just depends on what you're buying, right? And so Nick and I were talking about, go ahead.
No, it's okay. Well, just to support what you're saying. So like pending sales went way down, and now pending sales have actually been increasing, although they're not necessarily huge volume in pending sales. There has been a decreasing, if that makes any sense. So in some ways, pending sales are continuing to now move towards being on the rise again, right? So pending sales were actually decreasing in volume, and now they're actually increasing again in volume. Does that make sense?
Yeah, that's a great stat. And I love that because it makes headlines, right? And so what happens is that when they get a percentage of a decrease, it's the percentage of decrease, which might be a higher number, right? It's like, oh my gosh, pending sales are decreasing by this percentage. It's like, well, let's look at the percentage. So if we were getting, let's say in one particular area, three pending sales, let's say a month, right? And that number decreased to 2. Oh my God, pending sales have decreased by 33%.
I know. It's huge.
33% sounds huge. It's one month, right? And so it doesn't really mean that much. So really take a look at the actual data, right? I mean, anyway.
Yes, I could go on forever with data. And I think what Robert was alluding to is it's really, really hard to pencil something out for a multifamily if you're looking for cash flow. So if you're looking for a deal that has money in your pocket, that fits the 1% rule and fits a high cap rate, it's not going to happen. I mean, Robert and I looked at an amazing deal where it's going to be really difficult to do because of high interest rates, right? April 2022, interest rates were around 3.5. Before that, people were getting 2.25, 3% for even an investment property. So they were penciling out really good for buying apartments, buying houses, and the numbers were making sense. But after that April 2022, when the Fed continued to increase rates, it's really hard to make something pencil out. You almost got socked in the face, boom, and your cash flow just didn't happen. People approach us as real estate agents.
The whole market got socked in the face in the multifamily market. I mean, the whole market did. I mean, it's gone down by 20%.
When we talk to people, Robert, no worries. When we talk about people, if you're in it for cash flow, it's going to be really hard because you have to date the rate and marry the price. So we're going to get a discount on these apartments, right? You're seeing 20-30% decrease, you were saying, Christina, in prices, which means that's your basis. So whatever you buy that property, whatever you depreciate it and use it for financial reasons, that's going to be your basis. You're going to be able to use that. Your rate, you're going to be able to refinance it later, right? And you're kind of hedging on that because I'm not predicting anything. And unfortunately, rates are not going to go down anytime soon. It might go down a little bit, but we're talking percentage change. The Mortgage Bankers Association, Goldman Sachs all say high fives, low sixes. And there's studies showing when will the golden handcuffs come off? When will people that are, to Robert's point, in their houses for 30, 40 years finally feel free to get out of the golden handcuffs where 80% of the mortgages are below 3.5%?
In single family. So the last statistic I saw was that we were talking at 60% of the mortgages were below 4 to 4.5%. So I have a slightly different statistic, but it is at golden handcuffs in that a lot of people moved during COVID as well. So there's the fact that so many of the rates on the single family loans are attractive enough, especially in comparison to today's rate environment, that people don't want to move. 60 to 70% of the inventory has a low enough rate on their house that there's no interest in them moving. They don't want to surrender that payment to actually move down in housing size. Because if they sell now to keep the same payment, they'd actually have to get something smaller. So there's no interest in stepping down. So that's one piece of locking up the market. The other piece of locking up the market is that so many people moved during COVID into a home they were much more comfortable with. So it's this high volume of movement, high sales at that period. And then once they settle, they're like, no, I'm good. So now we have the pending demand has actually been answered. Some of it, like, I hate my home, it's too small, the baby's coming. We're moving now because we hate it, especially now during COVID. So the volume is more than half, almost a third. If you look at existing home sales by volume since 2022, it's literally a third. And the volume has to do with just lack of actual inventory available on the market and not lack of demand.
So just to bring back, the second question I have is we're in a cycle, right? So how are we looking at this cycle? How long is this cycle going to be, and how do we use this cycle to capture our market share? Investors getting their hands around better properties for better prices.
So I'll speak. In my market's really California, right? And I think so far as like investing in multifamily, if you're investing here locally, it's a very tough market unless you're building, right? And right now with the refinance, the rates the way they are, it makes that tough, right? So a lot of those are being sold. Hence why Christina invests out of state. I think that's a rush to for a lot of investors to find marketplaces, that can give you better returns from a single family flipping standpoint. And a market cycle, every year there's a cycle, and most people miss it unless you're kind of a very diversified investor and you're not just doing flips, but you're doing, let's say, room additions, ADUs, new construction, and you're doing all of these things. Then what happens is that if you're just flipping, right, then you want to buy and time it so that you're reselling during that spring, summer months, right, and not buying during those spring, summer months to resell during the winter, because every year there's an ebb and flow of values, right? And while most of the times everyone gets fixated on the year over year numbers, and wow, year over year, the market's going to be up, 3%, 4%, 5%, 6%, whatever the number is, doesn't matter, right? Intra year, what happens is that there's a kind of a movement from those values that ranges between a 5 and 7% swing. So if you're buying at the high, and you have, let's say, a 7% dip in values because you now sell right around Christmas, and your margin's a 10% margin, you're making next to no money. If that project took a little longer, you're breaking even, right? And you see this, I see this with clients over and over again, where they mistime the market or they take too long. If you're flipping, speed is your friend, or being slow is your friend if you're going to hit those spring markets, right? I have a deal that we could have finished and we could have been done right at the end of December. We slowed it down to work on other projects because we wanted to hit the market March, April. So now we're 2 weeks away from finishing, and we're hitting our target. Now we extended the amount of time, which means, yes, we had a debt service and we had to pay those. But that 5% markup that we're picking up is far more than the payments that we get. So let's say we gave up, in this case, roughly 40,000 in payments. We're picking up 250,000 in value, right? So this is a strategic move that we made, knowing this is what was going to happen during the spring months. And so you have to kind of look at those things. Now, I don't usually buy in September. And one of the reasons is that If you're buying in September, you're basing it on comparable sales from June, July, and August, right? So, and your June sales really happened in May or April, and they closed in June. And so, when you're looking at those numbers, I can't replicate that when I buy it in September, and my property is going to hit the market right at Christmas or somewhere during the holidays, or maybe just shortly after the holidays, right? Now I'm kind of at the bottom of the market there, at the low volume point and also the low value point. And so I tend to, like, if I'm going to buy something around September or October, I'm looking for the better deals. I get very aggressive on straight fixers the month of December, late November, December. I know that's the bottom. I'm trying to buy as much as I can. January, usually what happens is there's a lot of people on vacation, so I have less competition. But it's also, I know that it's the lull of the market. It's when everyone gets nervous. There's stuff that hits the market, that's sitting on the market a little bit longer. But it happens every single year. And there's charts that we can put up that show this. I think, Christina, you might have one, but it's when you're timing cycles, there's two cycles to be concerned with, right? It's the entry year cycle and when you're going to be exiting and then where the overall real estate cycle is and where you're at on that. Now, we're late into the cycle already, right? I mean, this is not an early cycle market. And so if you're doing, lot subdivisions and things along those lines, there's certainly, I'm not saying you're not going to make money. I'm just saying there's a greater risk of a potential downturn or change that is happening because you're late cycle. Now, from a demographic standpoint, personally, I think we're good until like 2030 plus, right? And so at least 2030, because that's when the demographic shift really starts to take form and be more significant. Right now, we have the millennials that are very slow. They've been slow to act. They've been slow to, form families. They're, in their 40s and they're just forming households. Previous generations did this in their late 20s. And so you have a pause that happened that caused a lower birth rate, lower household formation. That's hurt demand. All of these things kind of come into play. And then you look at interest rates, and the interest rates are higher, and wages haven't kept up with that pace. So it makes it your affordability is very low. I mean, all of these things come together to create this perfect storm of like low inventory. Now, I look, even if the Fed doesn't, let's say, lower the rates from a Fed standpoint, I think rates can still come down, and we kind of saw that happening a little bit. And because right now the banks have a very high margin, their margins aren't as low. And the reason they have high margins is because, just think about it from a business standpoint. If you're a business and you have all of these hard fixed costs, you've got buildings, you've got leases, you've got ownership, you've got labor to staff all of that, but you've got low volume, your profit margin has to be better. Just think of it like a burger shop. If you have one client coming in and you need, that's what's happening. Your burger better be like $150 to sustain your expenses. And so that's what happens in mortgages. Their margin has to be better so that they can profit more to sustain their overhead. And so when volume increases, you'll see competition really increase because people will want the volume. And when they pick up the volume, right, they're going to make more money in volume. They'll compress their profit margins, and interest rates will naturally come down from a business standpoint and not necessarily from a Fed standpoint. So or you can have high unemployment, and then you'll have the bond yields kind of, people rush to the 10-year. The 10-year will drop, and that'll also drop interest rates. So there's several different ways where I think interest rates can come down without the Fed, lowering the Fed funds rate.
I was reading something that perception about the market when people are downsizing or upsizing, meaning their family is getting larger, right? They're looking to exchange houses. When is that break in interest rate attractive to them? Like, they're at 2.5%, 3.5%. At what rates do they have to come to for them to move out of their house to upgrade to a bigger house?
So I disagree with this a little bit, and I'll tell you why. I don't think that people are as interest rate locked as you think. I think people move when they have a necessity to move, right? If it's a job move, if it's a hey, God, we're really busting at the seams here. We've grown family size. We have a need now for more people. For more space, and And if it's going to cost them a little bit more, it's just going to cost them a little bit more. I don't think that that's the reason. The other thing is that if you look at the home sales as a whole, you've got roughly a third of the buyers are also sellers, and they've got their homes that are free and clear, right? And so the interest rates don't really mean anything to them. They're trading equity. And so when you're looking at that, this is a third of your marketplace, then you're dealing with the other two. And the other things is that for people that are buying homes, it's not really a factor of the interest rates. It's just they're buying it because it's not an investment, right? I mean, your house is not an investment. Your house is your shelter and your fight against inflation, and you're building equity over time, right? This isn't hey, I'm going to flip this house and be out in 2 years, unless that's the plan, and then make as much money as you can so you get that tax-free benefit, right? But that's a very small sector of the business, of the marketplace. Most of the people, when they're buying, it's their ability to afford that payment over a longer period of time, and it's their hedge against inflation, right? You don't have rental increases if they're not refinancing. They're building equity in their home, and over a 30-year period, in fact, I don't think there's ever been a 30-year period where the values haven't significantly increased, right? Probably quadrupled at least at the very minimum, and in recent much more significant. So, this is a great source for retirement income and for saving. So there's other reasons to move outside and to buy a home outside of, hey, the interest rates are high or low. It doesn't really matter.
I 100% agree with that. I think I was taking it from a different perspective because, of course, there are going to be births, deaths, marriages, people moving, people growing. Families are always, so there is always going to be a necessity to buy and sell real estate. Bottom line, I'm coming in from it from a perspective of interest rates. When are interest rates low enough to buy? And the stat shows that younger people entering the market perceive a 5.5. If it hits 5, they'll enter the market. But people that are locked into these low rates, maybe not the 30% that own it outright, but the people that have a low interest rate right now, around 3.5, they perceive as 4%. So it's going to be harder to unlock this inventory. I'm saying it's a domino effect. I'm saying, one of the dominoes for sure is people that are, growing their family size, decreasing their family size, births, deaths, marriages. That's definitely going to happen. That's one domino, but I think another domino is people entering the market. So first-time homebuyers are getting hit the hardest right now. High interest rates, their purchasing power goes a lot lower. They need to be by these cities because that's where the jobs are. They can't afford to move farther out from their job because they don't have job security as much as someone that has been in their career for 10, 20, 30 years. Likewise, people that are selling their house, let's say that are retiring baby boomers that have equity in their house, 100%, they're looking, some of that house is their retirement. So they're treating it very, very cautiously. I have a lot of sellers that are overpricing their houses just because they predicted that to be their egg, their golden egg. So they want as much money as possible. And we're seeing a lot of overpriced homes in the market here and in the DC market and California.
I think really what we're talking about is, well, what does make up the volume? So, because I've talked a little bit about volume and the stuck homes, right? The stuck homes, golden handcuffs, which has to do with the interest rate. And then there's that percentage of the market, which was people have already moved, they're settled in where they are because they're happy because of COVID. And then there's what Rob is talking about, which is there is a strong segment in the market that are all cash buyers, and they're not nearly as sensitive to this whole interest rate conversation. So there's still volume happening, still life events happening that are creating people still moving, even if they have the quote unquote golden handcuffs. So that's definitely still happening in the market, but volume has definitely gone down, like I said, by at least half since the interest rates have increased. It's the market, instead of collapsing itself based on the interest rate, has stalled itself based on the interest rate. And so it's a different behavior than we're seeing in some of the previous 2008, 2009. Like, people had to sell. They were cornered. They were upside down in their homes. Well, we're not looking at that. So I think that there's more stability in this downturn. And that, like you said, Robert, many times, not every downturn, not every recession creates a downturn inside of real estate itself. There are times when we have recessions where real estate is truly just sideways, is almost unaffected in the end result by the recession that's happening in other areas in the market. And the areas where real estate have the biggest effect is when we're seeing a financing crisis. Right? That's what you're talking about. So I'm kind of curious about, though, speaking of the fact that the Fed's not going to decrease rates this year, like that means something moving forward. And I want to talk to that in a minute. Like, what does it mean if they're not going to decrease rates? Well, in single families, it may not mean a lot that they're going to stay. Last time I saw, and maybe you guys have more current information, they're planning on decreasing rates maybe twice this year. That's what the Fed dot plot had in it, was a projection of potentially decreasing rates twice. They've only decreased rates once. This last Tuesday, this last meeting they had, they didn't decrease rates at all. They continued to maintain them, with statements having to do about, well, the market itself doesn't seem to be quite, with mixed signals, we're still concerned, and we're choosing to hold the interest rate steady. Well, really, they're turning the Titanic. So we knew they weren't going to decrease rates because they're trying to turn this whole market, not just real estate, but the economy. And we've got other factors going here as well, which has to do with Trumponomics or Trump economics. So I think that hybrid space, I think, is important for us to keep track of as investors. What will Trump economics create inside the space? If it creates a recession, which I think there's more concerns about that when we look at the stock market, that it could create a recession inside the US economy, is that recession really going to be touching real estate? And at what point will it touch? Because there is a point where it touches rents, right? It may not have to touch prices, especially in single family, but it might touch rents, which will definitely affect the compounding effect on the multifamily that's already been struggling since rates have increased. So not to lay out a whole bunch of topics, but I think I just did. Really what I want to talk about is that I think single families aren't going to be much affected, even if we have a recession due to concerns in the Trump economics, this current cycle that we're in, and his movements. What are your guys' thoughts? Are we going to see a decrease in real estate, single family, or not?
From a value perspective, I don't think so. I don't think we'll see a drop in values. I think that they'll hold pretty steady and have some slight growth. I think it's just another year. I think that the Fed has a real challenge, right? Because you've got unemployment increasing and inflation increasing at the same time, which typically don't go hand in hand. So on one hand, they'd like to lower interest rates and make things more affordable. On the other hand, they don't want to lower interest rates because they're afraid of inflation kind of taking hold again and running a little bit more. So I think they've got a tough job right now, right? Overall, I think they're probably supposed to lower interest rates. I think that's it's like the inflation that happened in large part, I think, was more COVID driven than it was economic driven, right? And it was certainly became economic driven because you had this pent up demand, but the pent up demand wasn't because of economics; it was because of COVID, right? And people weren't spending as much. You saw the savings rate skyrocket to the highest level ever, and the reason was, well, if you're stuck at home, you're not spending money. Right. And so then when you got out, you spent a bunch of money. Right. I mean, it's very, very typical. And if you studied any, past pandemics, this is a typical cycle. There's nothing abnormal about it. And so, it's funny because, there's a lot of blame that goes on to, the administrations that were in office during each period. Neither of them could have done anything different. It's really, they could have made slight changes potentially that would have had a slight impact, but this was a cycle of a pandemic that we went through, right? And it's don't take my word for it. Just look at past pandemics, and crack a book that'll tell you that. And so that whole thing, I think, is I think is where we're at right now. Is very like everything's in line with where we should be. Everything looks pretty normal to me, from an economic standpoint. I'm not really concerned about values dropping. I'm not really concerned about the demand dropping significantly. I think that unemployment could play a factor. I'm watching that, and I think that that certainly would play a factor. But I think that also that the banks, luckily, they do have a margin that they can, squeeze in order to create volume. And I think that's ultimately what's going to happen, is that you'll start seeing some competition in the mortgage markets for that business, and that'll kind of spur interest rates down a little bit. But you need some decent economic news for that to happen, right? And I think we're seeing a little bit of that, which is why the concern is for inflation. And it's offset by the fear of like, hey, wow, there's so many jobs being lost, and let's face it, like the Trump economics type scenario where, hey, you have this high unemployment because of, our largest employer is the government, right? And so when you look at the government and they're laying off tons and tons and tons of people, that's certainly going to affect consumer confidence. And to Nick's point, right, perception is key, right? And whether or not that moves the needle in a significant way doesn't really matter. It's what's being portrayed in the media, right? And that's creating that confidence or that fear. And the reality, we live in a market now where clicks matter, and they want you to click. And guess what? If I have great news, you might not click on it. But if I'm going to scare the hell out of you on it, you're going to lose your house and everything's happening because of this, you're more apt to look at that. It's the basis for, many like seminars who basically fearmonger to get you to click on that link to buy their seminar so you can, be part of it. It's not necessarily founded on true numbers. And if you look at the big picture and the overall picture, things look fairly normal. Now, can things change? Sure, there's like 5% outliers where things can always change. But I don't see anything significant this year. This year seems like it's going as expected. We're expecting layoffs. We'll expect, higher unemployment. And I think with that, as long as inflation stays, fairly level, I think that they'll probably reduce interest rates towards the end of the year.
So, the market does track with consumer confidence. And so I think that we want to be aware of the fact that with the stock market going down recently and consumer confidence going down as far as Trump economics, I think we do want to be aware of that piece of it. But I agree with you, Robert, that there isn't a lot on the horizon line that suggests that this cycle is going to be much different than other cycles. It's not going to be a 2008, 2009. I don't think that we have any basis in the market itself to allow for that. We also have a pure lack of volume, which also will mitigate any of the fear in the market actually hitting real estate. But I do think we want to be aware that the consumer confidence index is on its way down. That will make a difference, but ultimately I think it's not going to hit single family real estate very much at all. It's more of the multifamily, which is the space I want to play in, where we're already seeing a downturn, but that's based on numbers. It's based on the fact that multifamily cannot sustain the prices they had based on the interest rates going up. And that's going to maintain across this year in multifamily because they're not going to be decreasing rates. Slowly but surely, we're getting tired sellers in the multifamily market, but not nearly as quickly as I thought we were going to get. So hopefully we'll get more. We should get more of that in this upcoming year in 2025.
Yeah, I think that's a good segue for permit. We were talking a lot about permits and new construction and how those are indicators of housing supply. Because with more demand, more supply. What do you think? I know, Robert, you were talking about 2030 and hearing that is when the baby boomers are going to start exiting, and there's going to be a lot of less people buying houses because the newer generations are living in houses longer with their families. So this desire for supply won't be as much. Can you talk a little bit about what you're hearing on the development side for 2030?
So if you look at the market from a builder standpoint, let's look at the large national builders, right? One of the things that happens is that, they just came off of 2008, which wasn't really that long ago, right? And they'd overbuilt homes in 2005, and then they got stuck with these and had to take like really large discounts. They have a lot of land that they can build on, but they're not rushing to build, right? Because of low demand. And so you basically build to your demand level. And if you really want to make housing more affordable, you need them to build more, but they're in the profit business. They're not a nonprofit, right? So they're building to the levels that will optimize their returns. If you're a builder right now and you're looking at the market going forward, and there's this fear of recession, and there's these, the interest rates kind of still being on the higher side, it doesn't help them, right? And so if you're looking at it from their standpoint, they're going to build to the levels that they feel are going to optimize their returns. And that's what you're seeing right now. Now, that creates opportunities for smaller builders, certainly in areas like let's say Southern California, which is, outside of, it not actually being an island, it's kind of an island, right? Because you've got farmland on one side, you've got the ocean, Mexico, and then the mountain region. And here in this little area where everyone lives, this is kind of an island. And so, it's tough to find land, and there's kind of municipalities that are favoring development and with smaller lot divisions and the ADUs and other things, and SB9. They're really trying to spur this on a little bit more so that you can build a little bit more dense. I think that if you're a builder, you have to look at where the opportunities lie, right? And if we talk about I'm sure we're going to talk about the fire zones here shortly, but I'll touch on this. These fire zones, one of the things that's happening is that there's a, when there's that big of a movement, right? Because now you have an entire area that is changing, not just from a demographic standpoint, but also will a significant portion of it will change ownership, right? And let's say it's 35%. You have 35% that, let's say, won't come back. And your home buyers generally in that area account for, let's say, 20% are roughly investors. I'm throwing out rough numbers. I think it's 19.8% or something like that, but I'm just throwing out rough numbers. If 20% of those buyers are investors that are moving that are generally buying in that area, when you have a disaster like this and you've got opportunities to build new houses, what does that landscape look like for those new builds over there, right? One of the things that I learned this past week at our meeting from listening to the economist that we had, was that he brought something up in past fires, in past wildfire-like situations, that they saw the rental investor buyer increase by 40%. So that doesn't mean that 40% of all the buyers are now investor buyers. That means that 40%, there's a 40% increase of that that have been investor buyers, right? So that's that might take you to, let's say, 30% of the buyers that are investors. So what I should be doing is, instead of just buying to build a single family in that area, I should be buying a single family or building a single family and an ADU, which is going to be more attractive to that investor buyer, which is going to account for now potentially 1 in 5 or 2 in 5 of the buyers that enter that marketplace, right? And so to be more appealing to that, I should then do that. So that's one of the things, my takeaways for that. But from a standpoint of demographics and what I was referring to, like 2030, most larger national construction companies and builders, they are aware that post 2030, what will happen is that rather than building new homes, they're going to get into the buying of dilapidated or, let's say, deferred maintenance type homes that will be transferring hands. And so one of the things that happens now is that because of the exiting baby boomers, which means that you have more of them that will be dying off in a certain period of time, and you have their heirs, which are really Gen Z and millennials and Gen Xers. If it's a sole heir, they have a higher likelihood to just keep that property. When it's multiple heirs, the likelihood of that property being resold increases dramatically. In fact, I was an investor in a company that was trying to do predictive analytics, and one of the things that stood true was a home that was inherited that had debt on it, where the heirs already owned their own principal residences that also had debt, because it took an asset that would otherwise be a win and made it into a negative and a hardship for them. So they already have their income and they're used to living, and they've got their expenses, they're paying their mortgage, and now their heir dies and there's a debt on that mortgage, and now they're all chipping in to really fix this other house that isn't easily rentable because it's been it has deferred maintenance for years. That home tends to hit the market within 90 days of the last death of that exiting baby boomer or silent generation, which is happening. So that data, sorry, go ahead. Oh, got it. Okay, so I think that is going to press people to then jump into the fixture market, right? And look at those opportunities that will be available at that point, more so than building new construction. I think that if we have more new construction that gets built, that obviously alleviates things. But I think that that's really going to be market. I mean, it's not like Texas or Florida where there's a lot of land to just build. Here in Southern California, this is much more limited. It's much more difficult. The IE has done better because there's more jobs out there, thanks to, really companies like Amazon, right? Because the industrial space has really kind of boomed. So I think there's more job security in that area, which it didn't have in 2008, right? Where it was mostly a commuter area. It's not so much a commuter area as much anymore. And so I think that the economics for us here in Southern California look pretty good if we can manage, migration better.
Well, I hate to do this. Thank you, Nick. Thank you, Robert. I so appreciate it. Thank you, guys. Maybe we can do a part 2 when I get back in from out of town. This is Christina Suter, Real Estate Breakthroughs. So great to have my dear friends, Robert Fragoso and Nick, say your last name for me.
RedLAInvestorClub.com. You can access us there and all our great content.
Beautiful. And Robert, how do people get a hold of you?
You can go on to Instagram and follow Robert_Fragoso. It's FRAGOSO_JR for Judy.
Beautiful. And I'm Christina Suter, ChristinaSuter.com. Thank you so much, guys. We're just going to have to do a part 2.